Welcome to the Legal CFO.
Welcome to the show where clarity meets profitability. This is the Legal CFO with Ryan Kimler, the founder of Netprofit CFO. If you're a law firm owner looking to get a handle on your finances, grow your bottom line, and finally take control of your numbers, you're in the right place. Each episode, Ryan breaks down the business side of law with straightforward strategies to help your firm run smarter, earn more, and scale with confidence. I'm Evan Mack, and today we're talking about how law firm owners should think about their own pay. Ryan will explain how much to take, when it makes sense to increase it, and how those decisions affect profit, cash flow, and long-term stability. Ryan, sir, welcome.
Thank you for having me. I'm excited to be here today. Excited to dive in. Evan, it's always great to talk with you. So let's get to it.
Awesome, brother. It's been a minute. Ryan, how should a law firm owner think about their own pay differently from payroll for attorneys and staff?
Yeah, so I think there's a few different things to consider here. Number one, the people that you're employing, they don't have the risk of owning a business, and so as the owner, you've got to get yourself in a position where you're paid differently than the employees. I think we all know that deep down, right? I just want to remind law firm owners that there is a risk to it, right? And, as soon as possible, you definitely want to get away from insuring things or putting your own personal name on. You want to get it over to the law firm, right? Because worst case scenario would be if you end up going out of business and you're on the hook for something personally, right? Because then nobody wants to have to go get a job and also bring a bunch of debt with you, right? But you've really got to get yourself to a place where you're getting paid differently. You most likely, a lot of our listeners here today probably got in business so that they could control their own money and control their own time, right? So I think there's got to be a good salary component to it. Ideally, something that keeps you balanced, keeps you in a good financial position personally. And then also, if you can take some distributions on top of that, I think that can put you in a really good place where you're comfortable each year. Because if your personal finances end up being a wreck, you can wreck your business finances. So, as a business owner, I understand this myself as well. You've got to manage finances on both sides. You got to be paid differently. And so there's a lot that goes into it, a lot to think about.
What usually causes owner pay to swing wildly from north, month to month in law firms, even when revenue looks steady?
Yeah, so definitely collections timing, right, can throw things off. And that's why for the law firm owners that I work with, I love for you to set yourself up consistent salary that you can run your household on, right? That no matter what comes in, no matter what you've got going on, your number one priority is to pay yourself that dollar figure, right? Obviously, you've got to stay in business, right? But you've also got to pay yourself to keep your personal finances on track. And, sometimes, like, even if you all sit and think about what happens if your biggest client pays 10 days late, right? That could be a good portion of revenue. That's doing an exercise like that is what I would call like a stress test, right? But if you've got one or two big clients that's paying a majority of the bills for your law firm because of the work that you do for them, probably worth looking at how do we, spread that risk out? Because if all of a sudden they pay 10 days late, that could really stretch you on the business side on when you pay yourself. And so, building up a bit of reserve, right? I always love for my law firms to get to a place where we've got 2 or 3 months of cash in the bank to pay all of our bills. And that includes the owner's salary as well. So even if that client does pay 10 days late, we've still got the money sitting there that you can still take your own salary as the owner. But clients paying late, expenses going up, or even annual bills that you pay, like your malpractice insurance, right? If that comes out on an annual basis, if the timing of that, if that comes out in a slow month, that can really stress cash flow. Maybe you have a small team and you've got employees and maybe more than one of them was out on vacation. So billings are down, right? Lots of things can swing revenue, and definitely affect how much cash is coming in. And a lot of times you're not going to see that impact until like a month down the road, right? So you might have two employees that take a vacation in January. Well, that's going to affect February's billings, which then maybe affects March payments. So you might see that effect kind of lag as well.
Is there a point where paying yourself more actually hurts the firm's long-term profitability or maybe the stability of it?
Yes, for sure. Yeah. I mean, obviously, it again, as I talked about earlier, it's kind of a balancing act, right? I mean, I think we all know it takes money to grow and scale a law firm. And so there is a point where you can take too much money out to pay yourself and fund yourself personally, and then you get stuck in the law firm and you don't have enough money that you keep setting aside to let yourself grow to that next level, right? To make that next hire. Or um, or maybe you need to move into a bigger space,
Mm.
right? And you don't have the money set aside where, hey, while we're moving, we've got to have, two rent payments, and we've got to have another security deposit, right? And so you can definitely stretch yourself thin, paying yourself too much, right? So absolutely.
So Ryan, how does an owner pay, typically change as a firm moves from that early growth to a more, mature stage?
Yeah, I think this is where you can really get yourself in some dangerous situations. I mean, even as as the business scales and as you mature, it can be really tempting to, well, I hustled for so many years, right? And I barely got by, right? And now I need to get a bunch more out of the firm, right? I think there's times where that's reasonable, right? And that can be a good thing. And you want to pay yourself more, and maybe you did take on a little bit of personal debt in order to really get the firm up and going, and maybe it's time that you pay that back, right? Um, but again, just kind of monitoring levels and making sure, like, how much am I taking out each year, right? Because the other thing that's always going to hit you is taxes, no matter what, right? And so it might be like, man, the business has really scaled this year. We grew a lot, right? And I started taking a lot more money. And then the next year, is there money there to pay that tax bill,
Hmm.
right? So, that can come up and hit you as well. I think it's really, really important. I try to get all my owners, start taking money, setting it aside every single month. You can put it in, investments that are very liquid if you want to get some sort of return, like treasury bills or something like that, or short-term bonds, right? When interest rates are higher. But, you can definitely get yourself in a position where, well, I paid myself too much. I got myself into that next tax bracket, and now I'm having a hard time paying that bill next year. And you're having to take more money out of the firm just to pay your own taxes.
So what financial signals tell you it's safe to increase that owner compensation, and what signals say it's too soon?
Yeah, that's a really good question. It really depends on, what are our growth plans, and really having a projection for what does it take to grow, right? If we need that, more space, if we need to make that next hire. And I love to look at how many months of expenses do we have in the bank, right? If you're sitting at a place where, your firm's really humming along, and maybe you've been growing, and you have 1 month of cash in the bank, meaning if sales and money stop coming in the door tomorrow, you would be in business for 1 month. That's a little bit low for me to really be comfortable, really increasing owner compensation over, a permanent period, right? Maybe you can afford to pay yourself a bonus of some sort. But I really like to look at, months of cash in the bank, and I really like to see that consistent growth. I don't want to see, like, oh, maybe we went from $40,000 months to the last 2 months we've done $70,000 months. Like, I need that probably to be a longer term period, right? We need to really prove that, we didn't just take on some extra work or have some extra projects that funded, that growth, and it's a one time thing, or just a, minimal, or just a short term period, right? Because again, you move your salary. Um, we all kind of know how it goes, right? We all live a lifestyle, and that matches what we pay ourselves, right? Move your salary, move your lifestyle, and then all of a sudden, your revenue drops off a little bit, and you can't afford to still live that lifestyle again. That's where I see owners get in trouble, because none of us want to cut our lifestyle, right? Like once you, whatever lifestyle you're comfortable with, once you get to that level, right, none of us want to cut that back. It's not comfortable, right?
Mm-hmm.
So again, I look for consistency, I look for stability, and I look for, how much cash do we really have on hand for long term stability of the company too.
How do these taxes factor in, to owner pay decisions, especially when choosing between the salary distributions or withdrawals?
Yes. So something that's really, really important for all business owners to understand here in the United States, um, unless you have a C corp, which has some different rules with it, all of the taxes from your LLCs, from your S corps, from your partnerships, they all pass through and they become personal liabilities. So in other words, you own a company, you own an LLC, you own an LLC that's taxed as an S corp. Um, the IRS looks at the burden of taxes as you, the person, not the entity. So you can't expense tax payments. If you take money out of your company to pay taxes, even if you pay them directly out of your business account, right? Like if you go and log into your business account and send money directly to the IRS for an estimate, how that's really treated is even though it didn't come to you personally, it's credited as, well, you had the income first and then you turned around and paid the IRS. And so um, it's really important to understand that, because as you take out money from your firm to pay those taxes, that's going to be a distribution to you. You could run it through payroll, I suppose, right? Where, hey, I need $10,000 to pay taxes. I'm going to pay myself 15. Payroll taxes are going to come out of it. I'm going to net 10. But either way, when you're taking money out to pay taxes, it's going to add to your income for the next year,
Hmm.
right? So right now we're sitting here. It's February. We're in the month of February 2026. A lot of business returns are due in March and April. If I'm taking money out here in March and April of 2026 to pay my taxes from 2025, that income is going to be credited for my taxes for next year. It's money
Hmm.
that I took out in 2026. And so, getting to a place where you're on salary, I think is really important. When you're not taxed as an S corp and you're not on salary, you um, your tax self-employment tax. So, everybody that has a W-2, the government gets like Social Security money, right? Medicare money, Medicaid, right? That's contributing towards payments for you later. When you own an LLC and you're not required to have payroll, that money's not withheld, and so they take it out of the profits of the business. Um, where that's really a bad thing is, you might have profits of your business of, let's just say, $400,000 or $500,000. If you put yourself on salary at, let's say, $100,000, you're going to end up paying less in those self-employment taxes because you actually have a payroll. So there's some tax savings there. But I also like owners just to be on a consistent salary just for consistency. Again, as I talked about, like in their personal life. So I think it's important to have a good, healthy mix of, I'm on a consistent salary, I take distributions as I need it, sometimes like for taxes and things, right? And you're always planning that out. And then, additional distributions are really treated as like I'm paying myself a bonus for the business doing well. That's where I really like to get my owners to.
And you kind of talked about like the overpayment, but what problems tend to show up when the owners consistently underpay themselves, even if the firm is technically profitable?
Yes. So underpaying yourself, especially on like the salary side. Number one, if you're an S corporation and you're on payroll, and you underpay yourself for your job, it is possible to lose S corporation status, which then obviously you're back to an LLC and you're probably paying more in payroll taxes. And then obviously, uh, as an owner, I don't want you underpaying yourself where, you have really, really low salary or really, really low income, but your business profits are really, really high, right? And all the money is staying in the business. I don't want you to suffer on the personal side, right? So, that could be going into debt on the personal side because you're not taking enough out of the business, right? There's definitely a balancing act to it. And there again, right? When you're paying yourself a salary, that is going to reduce your profits when you're on payroll, right? And so, paying yourself too little of a salary, you could end up paying more in income taxes because your profits are higher, puts you in a higher tax bracket, right? So it's a balancing act. Highly recommend, get some folks with accounting background in your life, right? Help you manage this. Could be a CFO on the business side, could also, get them with your tax preparer, right? And really set things up and just plan your year out, right? That's one of the best things I can recommend. What do I really need to run my household? What do I need my salary to be? And then what's my goal as a total income goal, right? It's okay to have that as well. So maybe it's $100,000 salary, but I want to make 350. Well, we know you got to have distributions of 250. How are we getting that done, right? So just figuring all those things out, building a plan for it, getting those financial professionals in your life, super, super, super important, because it is a major balancing act and it's not easy.
So when a firm is reinvesting heavily in growth, how should an owner decide what to take now versus what to leave in the business, Ryan?
I'm always watching our months of expenses and watching your monthly expense number, right? And if you're an owner and you want to look at this really, really, really quickly, get your bank statement delivered electronically or in the mail, open it up. How much money left our bank account last month, right? So really, really rough number, can definitely fluctuate. If you can look at your last 2 or 3 months, it's going to give you a ballpark of what really went out of the account. Again, you could be missing some annual bills, right? And that number can fluctuate, but it gives you a good round number. And as you're assessing growth, again, I think really, really important. What's our cost really going to be in growth, right? What's our investment going to be in growth? And, then what's our expected return on that, right? If we're making that next hire, how is that going to change our revenue? Not just how does it change our expenses? We know, well, we're hiring another attorney and it's $125,000. Okay, great, right? Add in some benefits and all that and all in, maybe you're 150, 160 on, what it costs you for the year. But what is that person adding on the revenue side, right? How much profitability is being added by adding that person? So it's important to look at both sides. It's important to look at where do things stand today? How healthy is the company? How much cash do we have on hand? And then you can start weighing and making decisions on, how much can I afford to take out right now versus, if we're going to be stable in 5-6 months after we make that next hire, how much would I be able to take out then? Right. Which might be a higher amount if we've done things profitably and efficiently and we've really scaled the business.
All right. Ryan, thank you for your time, brother.
Absolutely. Thank you for having me.
Thanks for listening to the Legal CFO with Ryan Kimler. If you're ready to get financial clarity for your law firm, visit netprofitcfo.com to learn more about working with Ryan and his team. If this episode was helpful, be sure to subscribe, share it with another law firm owner, and leave a review because the more you know, the more you grow. Thank you so much, and we'll see you next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.